Welcome to the Explainer. Today, we're decoding a really powerful tool that traders have relied on for decades to get a read on market momentum, sometimes even before it happens. Yep, we're talking about the MACD indicator. For any trader, this is the million-dollar question, isn't it? Whether you're into stocks, forex, or crypto, timing is, well, pretty much everything. And getting that timing right often comes down to understanding one crucial force at play in the market. And that force is market momentum. It's all about reading the strength and the direction of a price trend. Getting a feel for this is absolutely crucial if you want to make smarter trading decisions. So how do you measure that momentum? Well, one of the most popular tools out there, designed specifically for this job, is the MACD. And believe me, there's a very good reason you see it on so many trading charts. So MACD stands for Moving Average Convergence Divergence. It sounds complicated, I know, but at its heart, it's pretty simple. It just tracks the relationship between two different moving averages. Think of these averages as just smoothed out versions of an asset's price. By comparing a faster moving average with a slower one, it gives us a peek under the hood of a trend. Okay, so to really get how the MACD works, we need to break it down. It's not just one wiggly line on a chart. It's actually an indicator built from three separate parts, all working together. Let's take a look at what those three components actually are. First up, you've got the MACD line itself. You can think of this as the fast line. So how do we get it? We just subtract the longer-term 26-period EMA from the shorter-term 12-period EMA. Now, because it gives more weight to the most recent prices, it reacts really quickly to what the market is doing right now. Next, we have the signal line. And you can probably guess this is our slow line. This is simply a 9-period EMA of the MACD line we just talked about. Its whole job is to smooth things out, kind of filter out all that market noise to give us cleaner, more reliable signals for potential trades. And finally, there's the histogram. This is awesome because it gives us a really clear visual snapshot of the relationship between our fast and slow lines. It's just a simple bar chart that shows you the exact distance between the MACD line and the signal line at any point in time. A really great way to think about the histogram is like a car's accelerator. When you see those bars getting bigger, it's like the foot is on the gas. Momentum is strong. But when they start shrinking, the foot's easing off, and that trend might be running out of steam. So you see, it's all a logical flow. We start with the price, we calculate two EMAs to get our fast MACD line, then we smooth that out to get the slow signal line, and the histogram, it just shows us the difference between those two. Each part just builds right on the last one. Okay, so now that we know all the parts, here's the big question. How do we actually read them? How do we turn these lines and bars into signals that we can actually act on? The single most important signal that the MACD gives us is something called the crossover. This is that moment, that key point when the fast MACD line and the slow signal line intersect. It's a huge clue that there's a potential shift in momentum. And there are basically two main types you're looking for. A bullish crossover happens when that fast MACD line crosses above the slow signal line. This suggests upward momentum is building up. And a bearish crossover is just the opposite. The fast line crosses below the slow line, hinting that downward momentum is taking control. But here's where the histogram becomes your best friend. It's your confirmation tool. So after a crossover, you want to see those histogram bars growing in the same direction. That confirms momentum is building behind the move. If those bars start shrinking, though, that's a warning sign that the new trend might already be losing its power. Okay, so let's walk through a really basic strategy you can use to put all this knowledge into practice. So, putting it all together is a pretty simple three-step process. First, you just patiently watch and wait to spot the crossover. Then, and this is critical, you look to the histogram for confirmation. Are those bars growing? Is momentum on your side? And only after you get that confirmation do you then consider making your move. But wait. Before you run off and start hunting for crossovers, we need to have a serious reality check. The MACD is a fantastic tool, but it is not perfect. And you absolutely have to understand its limitations. Which, leads us to the key question. Is this indicator foolproof? Can you just rely on it and nothing else? And the short answer is absolutely not. No way. The MACD is kind of notorious for giving you false signals in choppy sideways markets where there's no clear trend. And in really volatile times, it can create these confusing whipsaws where it just signals back and forth, which honestly can be a recipe for some quick losses. This is exactly why experienced traders never, ever use the MACD in a vacuum. You have to think of it as a powerful confirmation tool. It should be part of a bigger trading strategy, not the only reason you make a trade. And that really brings us to the most important takeaway of all. To make this work, you always have to seek confirmation. Use other indicators like the RSI or even just basic price action to double-check what the MACD is telling you. The MACD is an excellent tool for gauging momentum, but just remember, it's only one tool in your trading toolbox.